Hello, I'm Phil Shackelford, past board chair of the Bryan College Station Chamber of Commerce, and I'm proud to bring you our Chamber Chat series back, exploring an incredibly important topic of relevance right now in our community, and that's impact fees. Let me tell you, this is a very complex topic. If it were easy, then we wouldn't need a four-part series to discuss this. But we are very excited to have with us Dr. Adam Perdue to share with us really a very unbiased, nonpartisan, but a policy perspective, a study of impact fees and how they affect a community and how they affect our community. And so at this time, it is my pleasure to bring, and again, folks, it's a very, very complex issue. We have tried to boil it down into something that is palatable, and we hope you learn something. We hope that as a part of this four-part series, you learn some facts and knowledge from this first one. We look forward to engaging in opinions with all sides of the equation in the next few of our series, and then we look forward again to another critique of impact fees. And so at this time, it is my pleasure to bring Dr. Adam Perdue from the Texas Real Estate Research Center right here in College Station, Texas. And Dr. Perdue, we are excited to hear your study, and we can't thank you enough for helping to boil this down into something that the community can look at. Thank you.
I thank you, everybody, for having me, and it's a pleasure to be here today. As Phil said, my name is Adam Perdue, and I am a research scientist or research economist at the Texas Real Estate Research Center. Full disclosure, I am not a citizen of College Station or of Bryan, but of the county, and I live on the north end of the county, so I don't have any direct ties to this issue, but I am now a local, recently come up from Houston a few years ago. Anyway, so today I'm going to be talking about impact fees. So if we were all able to meet in person, which I wish we were able to by now, we would be having this meeting in College Station. But my presentation is going to be more general. On the one hand, I'm trying to talk about impact fees in general and the rules and the laws and the processes and the procedures and the economics underlying that and all that good stuff on a general term. But since you guys are going through the process right now, updating your impact fees, I am going to use some numbers from the previous impact fee studies done in 2016 for the city of College Station. But just more as, to point out the particulars and help talk about the generalities of the processes and procedures. Okay, hold on. I got a little bit of something up in my way. All right. So anyways, yeah, so we're going to be talking about the economics, and I put that on its own little bullet point because I am an economist. I'm an urban and regional economist, studied at the University of Houston and graduated with my PhD. And so this is the area that I'm an expert in. But the economics is actually relatively straightforward. Given a bunch of assumptions, a reasonable first principle that for a lot of things that people like to think about, balancing cost and benefits and making and whether or not people are paying the cost that they're imposing on society, or that people who are receiving the benefits from some good or service are the ones paying for the cost for that good or service. With a couple of assumptions and in theory and economics, and you can find worse first principles to be starting about. So well, I will discuss that, and we'll go through that. And but I'm also going to talk about the law, which is Chapter 395 in the state code. We've been touching on public finance and accounting, traffic engineering, and just the practical process that we go through to to calculate what the impact fees are, maximum impact fees are, and then we won't talk too much about the political process to figure where they decide what the actual impact fees are. But having said that, I am not a lawyer. I am the public policy economist here at the center now, but I'm not an expert on public finance or accounting. There were 20 years ago, I was a transportation engineer, which is marginally different from being a traffic engineer. But I was an engineer in training, and I never have been a professional engineer, and I have now let my engineering training license lapse. But anyway, so that's just full disclosure on all of that. But so we will be touching on each one of these parts. We will be touching on and utilizing the 2016 and specifically the 2016 roadway study from College Station's previous round and processes for initiating the impact fee. And then we'll go through all of that. And then, so actually, I've been looking at this for about 6 months or so, maybe a little bit longer. And so right, when I look at the processes and the procedures, I'm still, hoping to be able to eventually find somebody who can answer some of my questions, some of my remaining questions about how exactly we end up calculating all of the stuff that needs to be calculated for developing the impact fees for College Station, or for all of the municipalities across the state of Texas that would like to institute an impact fee. All right, so economics, right? So the most common economic justifications and discussions that we find when you start looking into people discussing impact fees and arguing back and forth, the primary one here in the state of Texas is talking about cost and benefits and trying to, talk about what the arguments generally are is that newcomers to a municipality impose costs that they don't necessarily have to pay for goods that they are benefiting. And that's the argument. And so, like I said already, I kind of touched on, as a first economic principle, given a whole bunch of assumptions and exactly beliefs and exactly what you want to talk about, a lot of times that's not necessarily a bad first principle to start with. That people who are imposing a cost, often you would want them to have to pay for that cost, and the people that are receiving benefits, often you want them to pay that cost. And with a certain number of assumptions within economics, right, a lot of good things will happen if the initial assumptions are true when we start on those first principles. And so I'm going to discuss how that ties into the discussion that you often hear in impact fees. And then there's another theory that doesn't apply too much to the state of Texas, or at least the way that people talk about this impact fees in the state of Texas. But in the economics literature, it comes up every now and then. And it's basically our impact fees justified by municipal budget constraints. And so I'll touch on that and the economics argument that people are making when they're discussing that kind of issue. And then finally, we'll go over in the economics section about who pays the impact fee, if and when, who we believe pays the impact fee, if and when it is charged. All right. And so, whenever the cost and the benefits that we're talking about here, when we're talking about the impact fees, are to the town, to existing, are thought to be to the existing taxpayers within a municipality. And then the benefits are the new infrastructure that are serving new development, and it goes to the new development. And we can, there's 3 different levels of this that we can look at. All right, and so like new development often requires the new infrastructure within that development, right? So that infrastructure is kind of clearly, primarily and solely benefiting the people that are involved in that new development, whether they're building it and getting to sell it at a higher price because the infrastructure exists, or whether they're moving there and utilizing the development. And so like the very obvious stuff are the roads and the water that directly serve that development, right? So on-site infrastructure. And the standard right now is a lot of that on-site infrastructure is already directly paid for by the developer for those larger plots. But there could be a discussion, often it is then transferred over to the ownership of the municipality. And so then we might be concerned that the maintenance falls, the maintenance and replacement and repair at a later point in time often fall towards to the municipality after the development is built. Then often we'll have new infrastructure that is required and is built by the city or municipality or their water service because of this new development. And oftentimes it will be hard to look at it and say, the whole municipality may still benefit from this new infrastructure, like so a water plant. If we have to add a new purification plant because the new development kind of requires it, but it still kind of benefits the whole city because we have increased water pressure. Now that we have 3 water plants instead of 2, if one goes out, we might still be able to maintain adequate water pressure and other kind of issues like that. It becomes maybe difficult to tell that all of the benefit of this new infrastructure is coming to this new development. It's kind of shared with the rest of the area. And then often this new development may or may not increase the load or cost on existing infrastructure. So this is kind of like, Highway 6 through town has already been developed. It's already 3 lanes wide in each direction at multiple points. And so we're not necessarily going to widen it because of new development, but the new developer, the new people coming into town may increase the load on that infrastructure and cost existing citizens extra travel time and all this other kind of stuff. So that's what the 3 levels of infrastructure that we often are considering when we are considering the impacts of new development on an existing municipality. And so then the opposite of that is the direct cost and to the development and the benefits to town. Generally, even the new development after it's completed, the new property owners and homeowners and retail, the investors who end up owning the retail and all the rest of the real estate structures that are built to serve this new development are going to have to pay taxes through time and or impact fees. And so then this may or may not be of benefit to the existing municipality, right? And so then our final questions that would be reasonable to be thinking about from an economic perspective are whether or not these taxes and or impact fees, when all combined together, that the new development is expected to pay are equivalent to the amount needed, or approximately equivalent to the amount needed to pay for the added burden of the new development on the municipal budget. And that's always just kind of a reasonable first principle that you can get from all of our certain assumptions in certain models in economics, and to start a discussion when you're talking about taxes and fees and all this other kind of stuff in relation to municipalities or any level of government, actually. And then there are also other things that we may or may not want to consider. Specifically, a lot of times externalities are something that we like to bring up. That kind of throws a kink in this kind of discussion. But there are also other concerns that might, that from an economic perspective, that might mitigate people's belief that this cost and benefit or cost and taxes paid necessarily need to be approximate. And so all of this is kind of just like the big picture, the things that not necessarily that economics tells us that we must consider, but kind of like an idea that we should. These are the reasonable things to be thinking about when you're coming from an economic perspective. Right. All right. Then there's also another kind of like, instead of this cost, right, talking about the new development necessarily imposing a cost on the existing taxpayers and municipalities, there's actually another theory that basically assumes that the development will pay for itself in future tax revenues or future tax revenues plus impact fees. we're starting with just future tax revenues here. But only the city can build this infrastructure. And there's a couple of different reasons why we see that kind of stuff in our public finance literature and economics and urban economics literature and stuff like that. But it's the way it kind of plays out in the real world too, that the infrastructure will increase the value of the land such that the developers would be willing to pay for it because it actually increases their value of land over and above the cost of that infrastructure. And right, if we found that the city has tax rates for such that it actually, the taxes in the future would be more than enough to pay for this infrastructure even up front. But for some reason, so then everybody kind of would benefit if we could hurry up and get this infrastructure in the ground. But for some reason, you know, the budget of the local municipality that would be the one to build that infrastructure is constrained. Often it's by current taxes or the ability, you know, the current taxes that you're allowed to take in or that you are taking in. You can't necessarily get bonding based on your expectations that you claim that you think you're going to get after you do this infrastructure, right? And so then if this is all the constraint and stuff like that, and everything else that we've said is true, then it becomes possible that actually everybody is better off with impact. And so that's definitely another theory within economic literature when they talk about whether or not who benefits and who gains and when impact fees may be worthwhile or when impact certain people may consider impact fees as worthwhile. At least in the state of Texas and reading the laws, and this one is not really economic, this is my opinion as reading the laws and reading the reports and hearing everybody in the state of Texas talk about this, actual rhetoric and practice here suggests that not many actually believe this. But again, it is theoretically possible as a thing in the economic literature. So these two combine, you know, just cost and benefits, basic cost and benefits, and you know whether or not you want those to kind of be equivalent, and then this whole idea that you know it's definitely worthwhile, but it's just the budget constraints that are hindering this absolutely worthwhile idea. These are all just the kind of these economic ideas that it is not preposterous to take kind of as a first principle when you're looking at this. All right, and so then another big part of the discussion that touches on economics and some of our economic literature that does exist about impact fees is who actually ends up paying. So whether it acts as a tax and you know somebody's actually paying or opens development attitudes opportunities and people are benefiting. Actually, in the economics literature, we're almost certain that it is not the developer builder. But normally there is a little kink here relative to the economics literature and our situation when we're talking about specifically about Brazos County, is that normally in the economic literature, when we're just thinking about this, we are considering large corporate developers, builders, as incredibly mobile capital. You know, so like somebody like D.R. Horton or KB Homes or you know, any of the LGI, you know, any of these big developer builders, they're completely indifferent about building in Dallas or Austin or Houston, and so then or in Brazos County. And so that if something happened in Brazos County that for a while raised the expected rate of return 0.5 percentage points higher than everywhere else, then we would see all these builders come here until they drove that expected rate of return down. Or if something happens in Brazos County that lowers the expected rate of return 0.5%, then all of these big corporate builders will just start building more houses and in Austin or Houston or Dallas and fewer houses in Brazos County. And so then, you know, but our market is a little bit different in that you know a lot of you guys who are building and developing in College Station and the surrounding areas are a little bit more tied to our area. But even then, right, you still have a lot of choices available. If something that College Station does raises the rate of return 0.5%, then you can build inside the College Station, Brian, boundary, and instead of in Bryan or in the unincorporated county. And if something College Station does that raises your expected rate of return 0.5%, you can build in Bryan or just outside of the College Station boundary in the unincorporated county. And so then what we really think is that most of this tax or impact fee or benefit of increased production and land value is actually going to end up getting split between landowners and the new buyers, the people who end up actually buying the houses. But when we talk about higher impact fees or higher taxes, we're almost certain that quantity of houses will almost certainly fall. And it'll be split to slightly lower prices to existing developable landowners and higher final housing higher final housing prices to the newcomers. Sorry. And that is, so something I haven't mentioned yet, I left off here. When we're talking about here, we're talking about if we end up total net, the sum of taxes plus impact fees end up higher when we pay, when we institute a new impact fee, or higher taxes is when all of this kind of idea applies. Okay. So I'm gonna get started on the process. So your College Station Planning Department is currently going through a series of presentations, and they have them available online. And actually, they take a slightly different tack. It's definitely prettier than my presentation. And so then if you find that I'm a little bit sluggish on the process and all of that, I would recommend that you go ahead and go talk to your planning department. But they have their current presentation available for you to peruse online. So this is the direct access website, but I also just Googled College Station impact fee planning, and it's the very first result. And so then, they are going around trying to keep you as informed as possible about the process and everything also. And I highly suggest that you reach out and do their presentation and talk to them also. But the underlying law for the state of Texas is called Chapter 395. And, just very, very quickly, it's basically, it is the impact fee. It lays out that the impact fee, what they can pay for, and that is the kind of capital and finance cost of attributable and necessitated or required infrastructure. And when we say attributable to the new development and necessitated by the new development. And you can actually have it in 4 different areas, which is water, wastewater, stormwater, and roadway facilities. In the state of California, they essentially let impact fees charge you for everything. And so there's cities where they have $180,000 total impact. But anyways, and then they do limit the impact fees to service areas, which for water and wastewater is exactly what you would imagine. The service area of the water and wastewater infrastructure, the whole system is kind of the limit. You can also kind of subdivide that if it makes sense. Stormwater is limited by drainage basins, is each service area, and then roadway facilities are limited. Their service areas are 6 miles. They didn't tell you 6 miles or what. They didn't tell you 6 miles radius, 6 miles diameter, 6 miles along service basins, which would be, or however, it's just 6 miles. And as a thing, College Station decided that was approximately 4 mile diameter to stay under the 6 miles. But anyways, and you have to go through a whole process, which includes this capital improvement plan process, which is just basically the whole description of the existing facilities and the existing usage, and the improvements in each service area and necessitated by the new development and their cost, the relationship between development types. So what is coming in to this development type, into the new development? Are they homes? Are they new industrial facilities? Is it new to retail establishment, fast food joints, et cetera, et cetera. Projection cost, all right, and then facilities usage. So does that fast food restaurant, how much driving does that increase? How much does that increase driving? How much water usage does that increase? How much flood, how much flood runoff does that increase, et cetera, per each different type of development. Projection of the total number of new service units expected to come in with new development. And then basically you end up, oh yeah, I'm sorry, then you're supposed to credit for the expected property taxes that is going to be recollected to pay for this infrastructure by the new development. And then you come up, and then basically, once you give the credit towards the total cost, and you divide by the calculated number of service units that will be coming in every year, or over a 10-year period, then you have this maximum impact fee per service unit. And so what this is supposed to be is that when a new house comes in, we expect them to add this burden on, or what this is stated as being, so when this new housing unit comes in, we're expecting this kind of burden on our sewer system and our water system or our roadway system that they will not be paying towards over and above what they're going to be paying in their tax. Is basically the stated assumptions or stated and implicit assumptions within this whole processes and procedures of the impact fee law and report. So here for the roadway, and I'm going to go over the next few ones pretty quick, right? Again, like I recommend, you'll be able to reach out to me anytime if you have any questions. But actually, your planning department is probably the better for the processes and procedures. The planning department is probably often going to be the better choice to ask with very specific questions about this kind of stuff. But these are the roadway service areas that you have. Water and wastewater service areas are where does the city of College Station extend their water and wastewater services across the whole area. But we have 4 different areas bounded, where A and B are on the northwest side, right, all the way up to the border of Bryan. C and D are more towards the southeast. With all of them bounded by either Texas Avenue on the north end or the freeway, State Highway 6 freeway on the south. Okay. And then we come up with a whole list of the necessitated capital improvements. So for roadway, right, it's limited by these individual service areas. And these are the roads that the engineers and the planners believe are being necessitated by this new development. And then if you look at the water and wastewater, right, it would be the new pipes and the new water purification plants and the sewer treatment plants and all that other stuff. Here, right, they break it down by service area. How much is all that new infrastructure in the CIP going to cost to build? Right, what are the projections for new development in each area coming from the planning department? Roughly for the 2016, it ended up being about a growth of about 2.5% per year for 10 years, which I have absolutely no concern or complaint about there. And then they look at your comprehensive plans and where this growth and what type of growth and development can occur based on the comprehensive plan in each area. So then we were able to, for the roadway people, for the roadway report, we translate each one of these service areas to expected vehicle miles traveled during the PM period. And so by the end of this, by the end of the 10 years in 2026, there's expected to be added 62,000 vehicle miles traveled every PM peak period. Which they don't have specifically what that ends up being in College Station, but somewhere around 4:30 to 5:30, we're going to have 62,000 extra miles traveled by 2026. Is the expectation of the planning department and the engineers who helped and assisted on this report. And then basically for the roadway, right, we break down for each service area what this maximum accessible fee per our service unit here, which is vehicle miles. So it just so happens that water and wastewater, the service unit is based on the diameter of your incoming water pipe. So it's like 5/8 inch or 1 inch, and but so the service units end up being different on each one, but you just translate it all back into per service unit. And so it turns out, right, like the single family service unit has, single family dwelling ends up being estimated or predicted to be, or assumed to be 4 miles, 4 vehicle miles, additional vehicle miles traveled every PM peak period that we add for every single family residential that we add. I don't know the rest of the translations off the top of my head. But then, right, we have our max, we could divide the 853 for the 5,000 square foot fast food restaurant with drive-through in area D by 4,004, and you would have the predicted number of vehicle miles traveled because of the added fast food restaurant. All right, and so then this is all basically the numbers that this process comes up with for service area D, which for the roadway is the maximum predicted, highest maximum impact fee for a single family home of $16,000. In the end, the city council decided on $1,500 per single family home. All right. And so the water and the wastewater all follow a similar process, and they come up with different sets of numbers and these is all translated to single family homes. And so thus in the end, if they had used the maximum estimated impact fee, where the maximum is limited by the law, we would have seen single family homes paying a total of over $17,000 in impact fees upon permitting. And then it ended up instead that the statutory impact fee per single family home was a little bit less than 1/3 of that, and $5,000. Okay. So the reported impact on the community. So this is basically, I'm just wanting to translate, right? What would the fees would have been? And we're going to get at how much does that actually end up being relative to prices of single family homes is where we will end up here. But essentially, if the maximum impact fee was predicted to collect $23 million per year for 10 years. And as of 2016, that would have been essentially to replace that over 20 years. So this is where we start getting in kind of the public finance, right? We want the debt service taxes to be over the same kind of time period that the bonds would have to be, and the bonds get bonded out in a specific kind of thing. But anyways, so some approximation of doubling the 2016 debt service property tax for 20 years would have been required to collect the same amount of revenue as this $23 million per year that would have been expected from the maximum impact fee. And then to replace the eventual statutory fee, we would have lowered that by a little bit more than a little bit less than 2/3. So it ends up being about 8 cents per hundred, which is a little bit less than half of the existing debt service impact fee at the time, to collect about $7 million. All right. Relative to the single family home values in the municipality of College Station, we've been developing our tax roll data. We're pulling the tax roll data from all of the local appraisal districts, and that's where this comes from. And it's the 2019 estimated values by the Brazos County for all these homes. So on average in College Station, the county appraisal district believes that the average single family home value in College Station was $275 across all single family homes. For those built after the impact fee, on average, the value was $367,000. So a lot of the concern that people often have when discussing impact fees is affordability issues. So I went ahead and kind of rough approximation of the more affordable homes would be those less than 2,000 square feet, depending on exactly what your definition of smaller and affordable home is. And so then if we limit the county appraised value for those built between 2017 and 2018 that were less than 2,000 square feet, the average value was $213,000. Here's the debt. In the next column, I give the debt service tax, average debt service tax paid per each one of those classifications of single family homes in College Station. But the end result is that the weighted average maximum impact fee would have been equivalent to about 5% of the average of all of the new homes and 8% of the smaller new homes. And then basically we can cut both of those by about a third to get the statutory impact fee would have ended up being about 1.5% of the value of all new homes in College Station, and a little bit over 2% of the average value of all of the smaller, presumably more affordable new homes in College Station. Okay. All right, so that's my discussion, right? We've walked you through the economics, and it's just relatively straightforward the way most people talk about it. And again, theoretically, given assumptions that we use in economics, balancing cost and benefits and cost and how much is paid often leads to, depending on your assumptions, a lot of good things in economics. And so then we could all discuss whether or not those assumptions hold true. But on a basic principle, trying to balance the cost imposed by somebody's decision and how much they have to pay for that decision is not out of the blue when you're talking about right, when you're trying to look at these kind of questions based on an economic frame. The particular process, right? So what I went through on all the process, was trying to be mostly in general, but we did discuss the particulars of College Station. And so, I have been trying to pick this up for, actually, as I said 6 months earlier, but probably about a year by now. And so when I go through these impact fees, I've been looking at them across the state of Texas, but we're going to again focus on College Station roadway impact fees. These are, I want to go through the kind of questions that I'm still having as of right now. There's still kind of I'm not 100% clear on how exactly it works or why they're making these particular kind of assumptions. And hopefully during this next month here or the next month or two, and the rest of the presentations that the chamber has ready for you guys, we'll get to learn these together. All right, so this is actually kind of just coming back in. If the impact fee, this balancing of cost and benefit, the basic idea there is something in economics called a Pigovian tax. That's kind of the balancing of an upfront fee versus a higher tax. In economics, you just pay. It's like whether you pay cash for your house or you pay a monthly payment. By and large, on the margin, people should be indifferent to that. There may be some affordability concerns because if you're trying to scratch and save, often it's a lot harder for you to scratch up that extra $1,000 in down payment than it would be for you to pay an extra $10 a month in taxes over the life of your house or the time period that you're living in College Station. So there may be some concerns there, and I haven't really seen anybody talk about that. And then if we're talking about it being kind of this, is it a substitution for taxes? When we're talking about an impact fee rate, we're talking a lot of the claims are that people are coming in and they're not paying their full fair share, and so tax rates are going to be higher. And so I haven't seen much of a discussion of what's actually happening in the tax rate after the fact. But then it also could be actually that municipalities were already undertaxed. So again, this is kind of right. So these two, this kind of question is more of a public finance question, which I am not specifically a public finance economist. And then but then a more particular question, which actually I'll go into in more depth here. This is basically kind of the claims and the rhetoric of the impact fee. Does the impact fee actually end up approximating the value of the necessitated infrastructure? And then just kind of the last one is kind of the same question about taxes. What is actually going on with taxes in these areas through history and after the impact fee happened? So actually, and this is going to end up being a question for me in the long term, because we want to kind of, we're hoping to be able to do economic studies, but these are really, really hard because we really, ideally, right, we want two identical cities right next to each other, and everything else is exactly the same, except for the median voter in one city decided to pass an impact fee, and the median voter in the other city decided not to pass an impact fee. And then we want to watch and see what happened in those two cities. How do their paths diverge? And it's almost impossible to find that kind of stuff, but we have some tools that we try to get close enough. And so then eventually, hopefully, I'll be able to do a real good study on that and come and answer that question. What are the actual impacts over time, impact fees or not? All right, and so one question here is, one of the implications is this required and necessitated by, the new development. And this is actually initially a question that it just kind of jumps out at me. But especially in our zone A for our roadway fees. And it's in the end, it's going to end up being what exactly is the definition, legal definition, and we'll have to ask a lawyer, right, for that question, of necessitated and required by. And so then we can look at pretty much any of these roads that are actually on the plan for development for service area A. Almost all of the people, all of the increase in growth on that section of Texas Avenue, which is, the planned projects are the red, but almost all of the growth in traffic on that section, the southern section of Texas Avenue in area A and B here, is actually going to be caused by the new development in areas C and D. And so, because that's the main transport route to get from areas C and D to the main driver of our local economy, which is Texas A&M University. And then similar kind of question that I have right on Harvey Avenue, right, is that a lot of that growth is the necessity for transforming Harvey from a 2-lane to a 4-lane arterial. Is primarily the development that's happening and occurring outside of the city limits of College Station, not being necessitated and required. Well, right, we have to ask about what the definition of necessitated and required by most of the development that's going to be occurring in service area A. And then even more so for this little section of Linda Lane that turns to the right off of Harvey Lane and goes directly outside of the city limit. And we see this really well in A, and I'll come back to, for the economist in me, this is actually not a concern. And basically, a lot of it is kind of the artifact of the restriction to the service areas written into the law. And so whether or not this is acceptable to me, it will have to be answered, acceptable has to be answered by the legislature and the lawyers and the actual law. And then another concern again here was that initially when I read this and it jumped out at me, is that percent of capacity added that is attributable to new growth ends up being 154%. So when you read the law, what this is telling us is that 154% the new demand that is added by that will be added by predicted growth is expected to be 50% larger than the supply of transportation that is added by these projects. All right, and so then that kind of jumps out at you a little bit, but absolutely, what happens with the law is that you cannot charge on it via an impact fee more than 100% of the cost of the projects that are added by the CIP. And so basically, when you see that 154%, what you know is that immediately the maximum impact fee is actually cut by 1/3 because the impact fee cannot be calculated to charge more than the cost of the new planned infrastructure. All right, and then back to the first slide, as an economist, when we're talking about balancing costs and benefits, right? This is just kind of a systematic concern. So it actually turns out that when you think about externalities, which is where you really talk about Pigovian taxes, and so externalities is when you impose more of a cost than you have to pay for on society for some kind of good or service. Right, which generally you're talking about pollution, but it also becomes an issue in roadways and roadways are difficult because there's no good way to exclude people from local roadways. And so then whenever you drive on a local roadway, you add congestion because you're not going to take into a concern, and there's no good way to charge you for the congestion that you cause, right? And so if we're thinking that systematically as this is a Pigovian tax, in economics, it actually doesn't matter what you spend the revenue collected on the Pigovian tax on. The Pigovian tax in and of itself will actually increase net revenue under certain assumptions and models. And so then I already discussed the issue with the 154%. But yeah, so and then my first issue too, the definition of capital improvements, right, or facility expansions and their costs necessitated by and attributable to new development area is going to have to be answered by either the legislature or a lawyer. And then we actually have, when we go down the service area D, we have the opposite problem, right? Or at least it jumps out to you, and it turns out not to be why you might think it's a problem in that manner. But in service area D, we have percent of capacity planned, really is the way to think about this instead of added, attributable to new growth is only 33% over the next 10 years. All right, so the impact fees legislation, when your planners are looking over 25, 30, 50 years, and all the projects that they believe are going to be necessary over that point in time, a lot of those get involved into the CIP. The impact fee legislation limits the impact fees to the consideration of what is required by the next 10 years of growth. And so when you see that 33%, that means that you are automatically cutting the impact fee, the maximum impact fee, by 66%. All right, so why you might think that's a problem when you first read that, it actually turns out to absolutely not be a problem, and most reasons why that might jump out. This is just a really simple question. They do a really good job in the report and the planners in their presentation and everybody. I'm just really curious. I haven't been able to find any explanation of how they actually calculate the credit that is supposed to be given back based on basically the taxes that this development will pay towards this infrastructure after it's developed, right? There's still going to be, when this property is developed, there's still going to be some amount of infrastructure tax too over and above the impact fee. And so some of that is going to kind of bleed into the infrastructure that the impact fee is going to be charging. And they don't want to the legislature does not want the impact fee to essentially be double charged, or the new development to be double charged for this infrastructure. And so they do this credit. And so then I'm just going to be reaching out and hopefully maybe somebody else will end up covering it, but exactly how and what goes into the calculation of this curve. All right. So far, I think I've kind of actually gotten a hand. Like, this is the kind of questions I've asked myself, and these other two, one is just a basic question, and our original ones, that's actually got a pretty. At least I'm satisfied, when I'm thinking about this as an attempt to kind of measure cost and benefit. But here I have some questions about the VMT, and so then these are still open questions for me. And I think that from my understanding as an urban economist and how these are calculated, and all of this, how VMT is calculated by the traffic engineer, I still have these questions. But one question I have about this is, why exactly are A, B, C, and D all the exact same vehicle miles traveled by land? So basically what that means is, as an assumption within this report, that the 300 unit, a new 300 unit apartment complex in Northgate is expected to add the exact same amount of travel to its system as the vehicle miles traveled by a new 300 unit apartment complex on William D. Fifth and Wellborn. And during the PM period. And to me, that I would question that assumption, is the best way to put it. Part of this problem is possibly the service area problem. C and D. So I've recently worked on a report where I pulled out travel time, commuting travel time for every census tract in Brazos County. And absolutely, it does end up that people who live further away from the intersection of Texas and University end up having larger commutes. But within the law and the processes and the procedure, the VMT is only calculated based on the service area. And so then it becomes a different issue. What is the average travel per new housing unit within each service area? And so then it might actually end up, that the one on the apartment unit on William D. Fitch in Wellborn, well, it's actually really close to the boundary of the service unit. But then we go ahead actually we'll get back to the issue with my question about that in a second. But anyway, so then there might be a problem with the service area. So the average travel for any apartment unit might be the same, because we're considering the smaller service areas rather than distance from where most people on average are trying to travel during their PM and AM commute. So here's just what we see from the data that I've gathered for my other report. And this instead was average commute time instead of vehicle miles traveled. And so then this is does not quite accurately reflect vehicle miles traveled, because for the outlying census tract, you're traveling much faster for a larger portion of your trip, because you're out there on the farm to market road with no stoplights and no intersections. But then we also find, the VMT is calculated as 4 miles of travel for residential, basic industry, and service industry. So basic industry is basically again, but it's, our industrial output, the jobs where we're producing something that ends up being exported out of the region. Services are stuff like, with your lawyers, your doctor's offices, and other kind of professional services. But we're assuming that each one of those jobs generate 4 miles of travel. And then we assume that 2 miles for retail during every PM peak period, but within each service area. So then for the 4 miles, we're assuming that within each service area, everybody goes the absolute farthest distance that is possible within that service area. And then except for 2 miles for retail, because then we are taking a calculation that basically taking into account that some of the retail travel will be within, within the boundaries of the service area. So I'm also question that assumption. Some people are going to live at William D. Fitch, and some people are going to live at Roxbury, both of which are within service area D. But when they're traveling in towards town, they are going to be traveling smaller amounts of time within service area D. And then also, residence and employment are direct drivers of travel demand. So I have no problem. I have no kind of question or concern about that. And you can actually, to me, we can all discuss or argue which one drives which, right? Without any industrial employment or growing industrial employment, there would be fewer jobs here in College Station, and then there would be fewer residents. Right, so we can split it between those two. We can sum it between, we can sum half between those two. That does not seem to be a problematic assumption. On the other hand, when the way that the Institute of Travel Engineering, Traffic Engineering or Transportation Engineering, I'm never quite sure which one it is, measures the trip generation, which is actually the starting point for this, is that they go to the parking lot and they count the number of people coming in and out. The problem with that is, as long as we were talking about residents and employment, the concern that one might have about that is that you are also picking up customer trips during the PM peak at retail and service, or potentially, right? And so this is a question that I would love to have a traffic engineer answer. But we're potentially picking up customer trips. But the problem with that is, if we are counting customer trips, is that actually a new retail or service, as within urban economics, new retail and services actually cut customer vehicle miles traveled, right? If we're saying something different, we would say we had an intersection, right, where on one corner there was a fast food restaurant or a gas station. If we add another fast food restaurant or gas station, we are not going to immediately double the number of people coming to that intersection. Or consider a grocery store. When we added the new HEB at William D. Fitch or the new HEB at Wellborn, we allowed people to stop going up to the Kroger from those communities around William D. Fitch to the Kroger at Roxbury, or we allowed the people who were commuting home and stopping at the Kroger to commute home and stop at the HEB at William D. Fitch and Sick, or take a more direct route and still be able to stop at the grocery store at Wellborn and William D. Fitch. These are still some of the questions that I have about how we've exactly calculated the VMT. What is, how exactly is the credit, the credit for taxes later paid by the new development towards the infrastructure actually calculated? And then also, what exactly do we mean by necessitated and attributable to new development? So, hopefully, I'll be attending the rest of this series. And so hopefully maybe some of these questions will be answered. And if I figured out the answer, if I have somebody directly reach out to me, I'll let you guys know at the chamber and across the community at large. But, any questions now and anytime. We here at the center are a service for the state of Texas. And so you can reach out to us at any time, and me in particular, my email's right there, and ask us any questions that you would like. general real estate economics or general conditions of economics across the state of Texas. I will not be able to answer exactly how the price of your house in particular is not going to change, so don't try that. But pretty much I welcome any other questions right now or at any time in the future. So thank you very much for having me. I hope that we were all able to learn a little bit more, and I look forward to learning more with this series at the Chamber of Commerce.
Dr. Perdue, thank you so much for your time today, and thank you for taking a very complex issue and again an economic issue and really breaking it down into manageable pieces about the process, how these fees are calculated, what goes into it, the CIP. Again, folks, you know, this is not something simple, and I know Dr. Perdue did his absolute best, and we greatly appreciated it, breaking it into manageable pieces that we can all chew on a little bit. And thanks to the Texas Real Estate Research Center for the work they do across the state of Texas, you know, to look at these issues and provide folks with the best data and information that they can possibly have. I hope you'll look, those of you that are watching, listening, watch for our additional chamber chats on this topic of impact fees. It's an incredibly important topic. There's policy positions that will be taking place in the coming days, and our goal is to inform of varying perspectives, inform of data and information so that all can make the best decision possible. If you have questions relating to this video and this presentation, you can certainly leave them in the comments below. We'll do our best to get those questions to Dr. Perdue and the Texas Real Estate Research Center and see if we can't get answers to some of those questions best we can. Again, thank you all for watching. Thank you for tuning in. We'll see you next time. Thanks much.